this stage last year, energy prices had fallen, but they were expected to get better by the middle of the year. In fact, last year they were expecting that by the end of 2015, energy prices would hit above $70. Clearly that didn't happen. In fact, prices are lower today than they were 1 year ago. This has had some significant implications on the Calgary market, not just last year, but will continue into 2016. So what are some of the things that happened? Well, clearly we saw a pullback in investment activity in the energy sector. Alberta went into a recession. We had a pullback in employment levels, so we saw job losses throughout the energy sector. There was a lack of consumer confidence in the market, and of course, less people moving to the province. All of this has had implications on the housing market, and it showed up in terms of less demand. So what do we see? Sales activity declined by 26%. While we were expecting to see slower sales, because the energy sector didn't start to improve in the second half of the year, it's why we saw such a pullback in actual sales activity. Now, sales activity does not always transpire into the same level of decline in pricing. Often they're misrepresented. Pricing, now we look at the benchmark price. Why? Because that represents the typical home. It takes away some of that impact of the higher end home sales and things like that. On an annual level, benchmark prices actually increased by 1%. Now many of you say, well, we've seen price declines. Keep in mind this is an annual figure. Prices have been trending down throughout 2015. Why did they not decline on an annual basis? It's to do with how our market was before we entered 2015. So to give some perspective, what happened in 14? We were in seller's market conditions. We had no inventory in the market. So when our market turned, we had the ability to absorb some of the additional inventory in the market without putting a lot of downward pressure on pricing. Now that being said, annual figures also don't give you the full perspective of what's happening. So when we look at our quarterly data, what we can see is essentially, we've had slower sales activity throughout the year. But in the first quarter, we saw the listings just didn't have time to react yet. So those listings were still higher, people weren't active, there was a lot of concern of what was happening in the market, so not a lot of movement and some downward pressure on pricing. However, as we moved into the second and third quarter, people reacted, and we saw those listings pull back. And what that did is it helped the market move into relatively more balanced position, and it limited some of the downward pressure on pricing. However, as we moved into the fourth quarter, I view this as the economic reality. We continued to see job losses, we continued to see weakness, the energy sector didn't appear to be improving, and we saw those listings start to rise a bit and keep those inventory levels elevated. And that caused the downward price pressure again. So as we move into 2016, we're moving into a far different scenario than what we had going into 2015. Now, before I go into the actual forecast for 2016, this year, it's important to note that when we're talking about these numbers, they're aggregate numbers. There are differences depending on the sector that you're in, the area of the city, the price range, all of that is different, and you have different price trends. One thing I wanted to point out, the detached sector. What do we see happen? Well, for example, homes under $500,000 in the detached market within the city of Calgary, when we look at the months of supply, so that's one measure of balance, it did increase a bit, but not to the levels that we saw in the past recession. Whereas if you look at that 600,000 plus market, we actually saw that months of supply increase to levels similar to what we saw throughout that last period. So what does that tell you? It tells me that there is likely to be very different price trends in the higher end of the market versus in the lower end of the detached market. Further to this, obviously the apartment market did differently. Right? So while on an annual basis, if we look just from January through to December, the detached home prices declined by 2%. Okay? That's the benchmark price. Apartments were far higher, closer to 4%. Okay, so there are differences. Another thing to consider is the part of the city that you're in. While on aggregate prices had moved down from January through to December, this didn't happen in every district of the city. While the city center did see some pullback, and that was really coinciding with that, it's one of the higher price detached markets. and we saw some price declines there throughout the year. But the Northeast actually saw price appreciation. It's important to note this because as we're in this cycle, it's extremely you can't just look at those aggregate numbers. When you're out there and you're dealing with these things, it's important to look at what's happening in your local niches because it will influence price trends. Now, with that being said, what is expected to happen in 2016? So, sales activity is expected to fall further. Now, this is following that 26% decline. We expect to see further contraction. Well, why is that? First of all, energy prices. We can't deny that the energy prices are low, and they're expected to stay low throughout 2016. Forecasts are changing regularly. There is an expectation that we'd be in this mid-30 range for WTI prices right through most of the spring, not increasing to over $40, $45 by the end of the year. Well, that has implications on demand. You're definitely not going to get a lot of employment activity, you're not going to get a lot of investment activity occurring, and this has that downward pressure on the housing market as far as demand goes. So what about employment? Now, in 2016, on an annual basis, we actually saw employment numbers increase. But that's because of the gains we had in the first 2 quarters. Now, those gains that we had in employment, though, represent different types of work. So you hear a lot about job losses, and well, we hear about layoffs all the time. How is that possible? Well, there was job losses in the business services sector, so that really represents that higher paid energy sector. However, there were gains in areas like the personal services and obviously the healthcare, education, that sort of thing. So that's where the areas where there was job growth. In part, which explains why there was differences between the higher end of the market and the lower end of the market. There was jobs being lost for typically the higher paid sectors. Now, going into 2016, further job losses are expected. Okay, so this is going to keep housing demand relatively weak. But another thing to note is looking at that level of unemployment. So as we go into 2016, we're entering 2016 with a 7% unemployment rate. So there's more people looking for work with less opportunities. Okay, put it in perspective, going into 2015, the unemployment rate was 4.7%. Okay, so it's a very different scenario. So now as you've had people unemployed for potentially a longer period of time, that also starts to influence supply in the housing market because some of those people who are able to pull off their new listings may have to rethink that and may have to start to actually list their homes and make those changes and adjustments. Another key point for demand is obviously net migration. Now, not a surprise. Not a lot of job opportunity is going to make it much more difficult to attract migrants into the city. So those levels are expected to ease off. Well, what does that do? Well, first of all, you'd have less people demanding rental product, and that filters into ownership as well. The next thing that it does is with the new construction that's happening, with less people coming here, it makes it more difficult to absorb up the supply in the market. Now, I'm talking a lot about supply. When we look at housing supply, we have to go beyond just what's in the resale market. We always have to consider what's in the rental market, what's in the new home, as well as the resale. This is the rental market. What did we see? 2015, we saw rental vacancy rates rise above 5%. This is just purpose-built apartment rental. This does not include the investors who've gone out and purchased units and added them to the rental pool. So that's secondary rental market. This is just purpose-built. And it's similar to levels that we saw in 2009. So there's a lot more choice in rental. So what does that do? Renters don't necessarily have to go into ownership. They can choose to stay there longer. They don't have as much pressure because they're not facing rising rental rates. So what that does is it's adding to that overall supply in the market. The next thing to consider is the new home side. Now, again, moving into 2015, we were very fortunate. There wasn't a lot of inventory either in the new home market. But we're starting to see those levels increase. We started to see that amount of inventory pick up throughout most of 2015. And further to that, there's a lot of products still under construction. If that product doesn't get absorbed, which will be more difficult to get absorbed because now there's less people moving here, we know some of that is pre-sold, but it's added competition in the market. There's just much more supply that we have to contend with. Now, another interesting thing to look at is the differences between that product under construction. We're often comparing to that 2007, 2008 cycle following the financial crisis. Yes, there is just as much product under construction, but what's interesting is a lot more of it is multifamily. So what does that include? Well, when we're talking about multifamily product, we're looking at that purpose-built rental is included in that number, as well as apartment-style condominiums, and that attached product. What we're seeing is a lot more of that product, so that tells me that when you're looking at what the impact will be on housing, that you might have a higher degree of impact in the apartment sector and that attached sector versus the detached. So, the resale market. Going into 2015, same story. We didn't have a lot of inventory in the market, giving us that ability to absorb up some of that inventory. But there is no question, we have seen the increased pressure on inventories, and they have been starting to rise. Now, they're not as high as they were in 2008, but they've definitely been increasing. Now, some of what happened again in the middle part of that year was because those listings levels were able to retract. Right? We will not necessarily have that luxury as we're entering into the second year of a slow economic cycle. But when you're looking at supply levels, it's always important to relate it to the amount of demand in the market. And this is really that months of supply ratio that we look at. What we've seen, again, that first quarter of the year, we saw that months of supply pick up. Why? There was a lot of concern. Consumers weren't acting. They didn't want it to know. It was the first time they've seen these oil prices drop, and they didn't know how to react to that. The expectations were they were going to improve. So they held off on any decisions that they had to make. We saw some of that shift through the second two quarters. Either way, as we're moving into 2016, we're starting the market in a buyer's conditions. This will influence pricing as we move into 2016. So what do we expect? Well, we do expect to see prices decline on an annual basis from 2015 by nearly 3.5%. Some steeper declines are expected in the apartment sector and in the attached sector, mostly because, again, they have more competition from the new home side. So we do expect to see steeper declines there than in the detached, but on average that'll account to a 3.5% decline. Now, many people have been looking at this market, and many people have a lot of opinions on what's happening on prices and comparing it to various cycles and going, well, why is it going to increase, decrease more? Well, as part of what we do is we look at, well, what did happen in previous cycles? It's an important perspective. So I am from Calgary, and I've heard a lot about the 80s. I grew up here, but I was too young to really understand the implications of it. But if we look back to the 80s, what actually happened in the 80s? Well, there was a widespread recession. There was the introduction of the National Energy Program. This was early 80s. Okay? It hurt our economy. We saw significant pullback in activity. Energy companies were suffering. People were leaving. So not only did we have slower net migration, it was actually negative. For 5 consecutive years, people left this province. That's bound to have an impact on the housing market. Further to that, we had double-digit unemployment rates. That is far worse than what we're seeing today. Now, what did happen in housing prices? If we look on a provincial basis, on an annual figure, okay, so not looking at those month-to-month adjustments, the housing prices were at their peak in 81, they declined to their trough at 1985, that was a 22% decline over that period. If you adjust it for inflation, it's closer to 40%. Okay, so it did have historically, some of the steepest price declines that we've seen. Now, we don't expect to see the same scenario. Also, at the time, don't forget, lending rates were in double digits. We are not anything near that today. So we can argue that those price declines that occurred at that time were far steeper than what we would expect through this cycle. And also keep in mind that those prices declined over a 4-year period. So that entire cycle, from peak to trough to recovery, was 9 years. Okay? So if it's not like that, well, what about the Great Recession as they term it, which is really the implications of the financial crisis? So this is much more recent. Well, what did we see in that time? We saw the financial crisis was much more widespread. It wasn't just contained to what was happening in the energy sector. Now people say, well, it's different, but oil prices recovered sooner. Absolutely, they did. They only stayed below $70 for a 9-month period on a monthly figure, right? But at the same time, let's not forget what happened to natural gas at that time. Natural prices went down and never really recovered. Okay, so there was some shifts that also happened. Another thing when I look at it is the impact, the relativeness of that recession. So at that time, our GDP declined by over 4%. The recession last year, the expected or estimated numbers are about a 1% decline. Okay, so not nearly as deep as what we've seen previously. If we look at other indicators, the net migration, yes, net migration levels are expected to fall this year. But again, those absolute levels are still expected to be slightly higher than what we had throughout the last recession. Okay, so on a relative terms, it's not as deep as what we just went through. Now, for there, on a monthly basis, the peak to trough was 18%. If you did it on an annual basis, it's about a 12% peak to trough over a 2-year period. So that's a 6% decline on an annual basis, if you looked at it that way. Now that cycle lasted 6 years. Again, that's from peak to trough to final price recovery. So our prices really just recovered in 2013. And keep in mind that that price correction happened was following a 40% increase in prices in this market, not adjusted for inflation. Also, again, we just saw that the inventory levels were far higher in that last recession. So clearly there is still some differences. Now that being said, what is going on in our market? There still is downward pressure. We do still expect to see pricing decreases. We expect to see that weaker demand. But what will happen will ultimately depend on a duration here. So what we're looking at is, keep in mind, we're in the 2nd year of a slower economic climate. And the impact on the housing market will essentially depend on how long this slow economic environment will persist. If things do get worse, and I'm not just talking about the oil prices, but the impact that they have on employment. So if we see more job losses happening in the energy sector, and not just that, but spilling over into other sectors at a higher rate than anyone anticipated, that can cause steeper than expected price declines. Now at the same time, let's keep in mind, look how much the market's changed in 1 year. This can happen on either side. Oil prices are extremely volatile. Will it happen in 2016? Very unlikely. I think most people are on side with the fact that this low energy price environment will persist throughout 2016. Other things that can influence what happens to our economy, government policy changes. We saw what the National Energy Program did. Now this can be either positive or negative, depending on what changes actually occur. So what those changes will do to employment levels, how it will encourage investment into the province, this can influence our market as well. And this is just something that we have to continue to watch to see what those potential impacts are. The next thing, obviously, housing supply levels. My biggest concern is what will happen if that product doesn't get absorbed. If that ability to absorb that supply in the market is diminished, that can cause a further downward pressure. But if some of those employment losses are stopped and people can maintain their jobs, stay in their homes, aren't forced into that selling scenario, then at the same time, then that housing supply might not be as much of an issue. So those are things to look for as we move through this year. With that, I'd like to thank you, and if you do have any questions, I'm always available. I will be at the industry panel at 3:15 today, and as always, you guys can feel free to always give me a call or contact me. With that, I'd like to thank you very much, and hand it back to Alan.
Nicely done as always.